Hi, I'm Chris Thornberg, Principal of Beacon Economics, and I'm here for a quarterly economic update for the Graziadio Business Review. Now, we've all seen a lot of the good numbers that we've in the economy over the past few months. We know fourth quarter growth was near 6%. The labor markets have stabilized, and increases in the number of hours being worked by people in the business sector, along with a lot of hiring and temporary employment, seems to indicate that we'll see payroll job growth return over the next 6 months or so. Consumer spending is on the rise, exports have been increasing, and industrial production overall has been growing quite solidly. It looks like the U.S. economy is definitely in recovery mode. In fact, 2010 may end up being a much better year than most economists think right now because of the fact that much of the government stimulus efforts have yet to work their way into the economy. For example, the $800 billion package approved by Congress to help stimulate the economy has yet to be fully spent. Even more importantly, the Federal Reserve has pumped about $1.3 trillion of liquidity into the economy through quantitative easing. Most of that is sitting in the banks in the form of excess reserves. Preliminary signs are that the credit markets are loosening, and if those banks start lending that money out, that could be a huge boost for the overall economic growth in 2010. Now, with all these good signs, with the fact that 2010 could be a positive year, is there a downside? And the answer is, unfortunately, yes, a very large one. Government programs to help stimulate the economy can get us through rough times, but they come at a cost. In this case, the costs are twofold. On one hand, the government's policies are creating their own set of problems. Namely, quantitative easing is creating the potential for lots and lots of inflation, and of course right now the federal government deficit is running at a whopping 10% of GDP. We know these things cannot last. On the other side of the equation, the fact is that government stimulus has not fixed the underlying problems that put us into this mess in the first place. Instead, they're simply masking them and in some cases making them worse. For example, the consumer. We know consumer spending is on the rise, but right now consumer spending is at an all-time high percent of personal income. The increase in savings we've seen over the past 4 or 5 months is an illusion created by those very steep tax cuts. Similarly, the real estate markets, those seem to be bouncing along, but again, that's due to the fact that interest rates are artificially low, and the FHA has ramped up its particular lending. And with all that in mind, when those policies are withdrawn, the real estate market is going to yet again suffer because of the fact that right now in the U.S. economy there's 6.5 million housing units that have non-performing mortgages on them. This is a problem we haven't even gotten close to fixing. So what does it all mean? Well, the government has more or less substituted the private bubble, which had burst in 2008 and created this economic downturn, and replaced it with a public bubble. A public bubble that's represented by this huge increase in the monetary base along with these massive fiscal deficits. At some point in time, they're going to have to pop that new bubble. And when they do, you can bet that the rapid recovery is going to slow down quite substantially. And in fact, if they don't manage that properly, we could actually dip into yet another recession. For more in-depth analysis, I would invite you to go to www.beaconecon.com and download this quarter's publication of Beaconomics. I would also invite you to join us on May 5th when Beacon Economics partners up with the Los Angeles Chamber of Commerce and the Graziadio School of Business to put on our annual Los Angeles Forecast event being held at the Marriott next to LAX. Until next quarter, this is Chris Thornberg signing off for the Graziadio Business Review.